inflation. There is one obvious outlier in the measurements, and that is domestic inflation, and that is services. So you have to get under the skin of that and determine what is behind it and what drives it up. Clearly it is wages, and because of this determination to avoid what I've called the tit for tat on previous occasions, we are also very attentive to profits. So it's a combination of the two. I'm not suggesting that wages should decline or that wage growth should be dampened. This is not what I'm saying. I'm saying that it's a major component of services and domestic inflations. Services is moving just a tiny bit. It was at 4% for the last 3 months. It's moved to 3.9%. Domestic inflation is slightly up. So we have to be specifically attentive to wages. And as many of you know, and as I'm sure you know, a lot of the indicators that we have, a lot of the data that we receive are a bit outdated. We will get the Q4 number tomorrow, which is more than 2 months after the end of the quarter. So we have to look at other indicators as well. We have our wage tracker, which sticks to all the agreements that are negotiated and signed. There is about a third of the employees that are covered by that wage tracker, of which the contract will stop being covered by an agreement as of now or at the latest in March. So we need to have that as well. We look at Indeed, as everybody does as well. And all these elements are showing us that there is an element of moderation. So growth is moderating. It's not going up as much as it did in late 22 and in the course of 23. It's the growth of it is moderating. So that's what we will be looking at very, very carefully. The fourth element that we also pay attention to is the corporate telephone survey, or the SMA as well, to hear from the corporate employers what is the labor shortage. How much hoarding do they have, to try to anticipate in a still tight labor market where wages are going to go.
Thank you, Madame Lagarde. And the next question goes to Minami Takeru of Nikkei. Minami, please.
Good afternoon, President Lagarde, and thank you so much for taking my question. So let me ask one question for better understanding. This is about wage growth and inflation. I think that even if wages continue to increase, the declining trend in underlying inflation may continue. It's just a possibility, but in this case, which one do you consider more important to decide to cut interest rates? The declining inflation trend or wage growth rate? Thank you so much.
Thank you so much for your question, but we will be looking at all of that, because we continue to look at the three key components: the inflation outlook, and that tells us what we should expect on the basis of the projections that are prepared by staff. And that indicates clearly that we are in this disinflationary process, that inflation is declining. But we also look at the underlying inflation and what feeds some of these underlying inflation, including in particular wages. So we also look at that because we want to be stable on three accounts: inflation outlook, underlying inflation, strength of transmission. On the latter, I think strength of transmission, we're seeing a good and solid transmission to the financing sector, and then further down the road to the economy. Thank you.
Thank you. And the last question goes to Jean-Philippe Lacour of AFP, Agence France-Presse. Jean-Philippe, please. You have to unmute. We do not hear you.
We do not see you either.
We do not hear you, Jean-Philippe. I'm very sorry. I can see you, but nobody
You can
hears
see
you.
him not happy with his computer. That's obviously the case.
Okay, well, it will be next time, Jean-Philippe. So we come to the end of our press conference. Thank you very much for following. The next press conference will be on the 11th of April. Until then, all the best. Thank you.
It's Bloomberg's Open. I'm Manish Cranny in for Jonathan Farrow. You've just heard from the President, Christine Lagarde. Data. More on that in just a moment. I want to set the stage for you on the equity front. This is what we've got for you. A nice, strong bid to equity markets this morning. It's day 2 of Jay Powell's testimony. The ECB leaves rates on hold. Powell did not embolden the no camp, less than 3 cuts narrative. The commercial real estate market is manageable. In terms of leading stocks this morning, again, that cap fits on Nvidia, bolstering the technology bid up nearly 1%, 18,185. Yeah, there are 2 directors in the Nvidia camp who are selling stock. They've been on the board since 1983. Nvidia is bid, stocks are strong. Let me just show you the reflection of what came from the ECB. This is where, in the very first instance, traders began to reprice 100 basis points of cuts this year. The growth outlook for this year was cut by the ECB. They talked about inflation coming to 2% in 2025, a dovish hue. Christine Lagarde came out and subtly but deftly unwound those bets. She talked about a gradual pace. She talked about a situation of where we don't have enough data. We won't have enough data in terms of movement. We will move before the core hits 2%. She needs more data to be more confident on moving. That sounds more like June. And in terms of a commitment to the pace, and this is something we must all get a hold of globally. There's a holding season that moves to restrictive, then you move to normalization. She will not commit to a pace, a rhythm, or a magnitude of cuts. And that is a global caveat we all need to grasp, from the Fed to the ECB to the Bank of Japan. Let me show you the immediate ramifications across the bond markets as well. In the very first instance, we saw a more significant drop in yield across the Bund, the Bubble, and the Schatz, 2s, 5s, and 10s. That has been unwound now as she talked about the concern about wages. Wages remaining hot, and that is 4.5% on wages, sequential core at 4.3%. The warnings were there in terms of the ability to move. They are not there yet. Christine Lagarde weighed in on the ECB's decision.
There are signs that growth in wages is starting to moderate. In addition, profits are absorbing part of the rising labor costs, which reduces the inflationary effects.
Joining me now to discuss is Invesco's Alessio De Longis and Winnie Sizer from Credit Insights. Winnie, to you first of all, this is a deft president. The market got all doved up on the headlines, and she came out basically, I think, giving the narrative that all central banks want to communicate, which is we're not there yet, we don't have the data yet, and if anything, this was a very clear narrative to the markets that central banks are so fearful of moving early, isn't it?
I think so, and I do think that Lagarde benefits from the hindsight of the December Fed press conference, where Powell came out much more dovish than we had anticipated. The market really took that, ran with it, financial conditions eased considerably, and central banks have not seen the progress on the data that they want to see to start to really talk about cuts being on the table, even though the market really continues to presume that they are.
Indeed, and in terms of that pro-risk narrative, and this is the point, Alessio. Again, all of these markets are in a pro-risk soft landing mode, aren't they? But the more that we hear from central banks, the more hesitation there is imbued in risk.
Yeah, correct. The first push towards risk was really driven by this expectation there would be meaningful and aggressive cuts. As that view didn't materialize, as you alluded to, didn't materialize really anywhere yet. Markets are still showing that resilience because ultimately they found a comfort zone with growth that is stable and improving on a go-forward basis. We saw it also in the projections for the ECB. While inflation, yes, it's not falling as rapidly as hoped, but it is at 2% on a projected basis. Basically, inflation is no longer a risk factor for the market. We talked about that Goldilocks scenario. That continues. No news is good news.
A very quick response from both of you. I want to move the agenda along to the US and to Powell, but very quickly, I had Allianz with me this morning, one of their chief economists, and basically said the biggest risk for the ECB is that the Fed does not move. Tail risk or real risk? Alessio?
The Fed not moving, I would call it still a tail risk. I more second your view from earlier, where I believe this cutting cycle for the major central banks is going to come somewhat synchronized, as you alluded to earlier. And that's also explaining why FX volatility, currency volatility is extremely reduced, with the exception of the Japanese yen. The Bank of Japan is the only central bank that is moving the other way towards rising interest rates. That could be the main story for the second half of the year.
It could indeed, and then we can debate whether that's one and done and what that does. Winnie, before we shift to the Fed, how important is it that the Fed goes before the ECB has the capacity to go? Because it's a danger, according to Allianz.
Yeah, so we have expected that the Fed is going to go first, just given the progress of inflation in the U.S. versus the Eurozone until recently. Now I think it's a little bit more of an even split. We do expect that the Fed should go as soon as May and the ECB perhaps in June, but I don't know that necessarily we need to see the Fed cut in May in order to see the ECB cut in June.
Okay, the sequencing, let's see whether it is a concertina as always, or as it historically been. Okay, stay with me, team. We've got a little bit more fresh data out of the US today. Investors are gearing up for the second day of Fed Chair Powell's testimony and the US payrolls report. We're counting down to that. Mike McKee is with me. I don't know whether it's too early for the whisper number. Mike, good morning.
Well, the whisper number for tomorrow is pretty much what we're getting for the consensus number. I'll get to that in just a second. Here's the data from today. If you're looking for something to push the Fed one way or another, you're not getting it, because basically what we are getting is data that doesn't show much change in the state of the U.S. economy. Jobless claims, same as last week. Continuing claims go up just a little bit, but that's because the previous week was revised lower. January trade, the one outlier, a little bit weaker trade deficit, and that does subtract a little bit from first quarter growth. Productivity unchanged in its revision. So market looking at these numbers, I mean, we're pretty much status quo in the economy. So what does Jay Powell say today? Well, on rates, it's going to be the same story, you know, maybe sometime this year, but not yet. Bank regulations were big in the House yesterday. They'll probably be even bigger in the Senate today. Elizabeth Warren, Sherrod Brown, he'll say they're still reviewing it. Yesterday he said, do expect changes. Balance sheet, he said yesterday, not an issue. QT continues. The one thing that didn't really get asked yesterday, might come up today, is on the U.S. debt. He said on 60 Minutes that it's unsustainable, but he'll take the usual Fed attitude of, you guys fix it, we don't get involved in this. You mentioned the jobs numbers, so let's see where we are now. February payrolls expected to come in at 200,000, the whisper number 203,000. So Wall Street leaning pretty much with the consensus. Private payrolls up 160,000. That compares to the 140,000 private payrolls we got yesterday at ADP. No change in unemployment, and we do expect, or at least economists do, a drop in average hourly earnings on a month-over-month basis that pushes the year-over-year down as well. That would be welcome news to the Fed, which thinks that year-over-year we should be running about 3 to 3.5% for sustainable inflation. But that's the only kind of outlier in the forecast for tomorrow. Although, man, I have to say, 200,000 seems like a big drop from 353,000, but a couple of months ago we were talking about 180,000 as a big number. So we're still looking at a very strong labor market.
Yeah, unemployment sub 4% and wages are strong. Mike McKee, thank you very much. My guests this morning are Alessio de Longis and Winnie Caesar on the markets. Alessio, to you first of all, I mean, you know, we start another day. It's been almost, let me just give you the fact. I mean, I was quite shocked by this. The longest streak without a 2% drop. I mean, this market is bolstered by investment liquidity and topped up by retail flow. Yet you have a concern that that there is going to be a moment of where we return to the mean, and you make this point. How soon will this market take a breath?
What we refer to a bit of a return to the mean is particularly to the biggest spread, the biggest anomaly that we have seen from a cyclical perspective, which is this outsized outperformance of quality mega cap tech relative to sectors and styles in the equity market that at this junction with improving growth and stable inflation should have outperformed much better, such as small caps, mid caps, value-oriented sectors. These cyclical sectors have lagged the cyclical move. That's the mean reversion that we are more concerned, actually not concerned, actually positioned for. But in this environment, the overall equity market and risk assets in general, including credit, we believe until something breaks, and it doesn't look imminent, investors, in our opinion, are still compensated to take risk, whether it's credit risk or equity risk. And it's only in the equity market that we will suggest a rotation in favor of cyclicals, expecting some mean reversion in the outperformance of mega cap tech.
So Winnie, it's the perfect world, isn't it? Nothing's breaking. Alessio's chilled. He wants to take risk. We're all bulled up pretty much every day. I don't know how much more bullish we can all become, but is there enough in credit for you? Is there enough return briefly in credit for you at the moment?
I would say on an all-in yield and total return basis, absolutely. Yields are still quite elevated, really globally across credit. It's that spread dynamic. How much are you getting paid to actually take credit risk that people are a little bit more wary of? And we've seen an interesting shift this year where triple Cs have been underperforming. Spreads are a bit wider there year to date, which is a reversal from what we saw in 2023.
Okay. Thank you very much, Alessio and Winnie. On the markets coming up, countdown to State of the Union with the details on what to expect right here on Bloomberg. Good morning.
This is probably the most important speech he's going to give the American people. President Biden right now is historically behind every single president except President Carter on 5 to 6 of the most critical metrics that we've relied on historically to gauge how strong a president's position is going into re-election.
President Biden prepares for a consequential State of the Union address. That's tonight, 9 p.m. Eastern. This comes as Biden faces mounting pressure on an array of political issues, including immigration and the economy, as well as concerns over his age. Anne-Marie Hordern is in the Capitol for us, tracking the State of the Union. Anne-Marie, good to have you with me. We've talked about the significance of this speech. I really want to drill into the content in terms of the key message. Good morning.
Good morning, Manus. Yeah, the significance is not lost on anyone. A lot of people in Washington are calling this, Greg Valliere this morning in his note, Biden's most important speech of his presidency, given the fact that it's not just a report to Congress and the American people about the State of the Union, but the fact of the matter is that what he is going to be pitching if he was to be reelected in the next 4 years. So when you get into some of the substance, what matters to the markets, you know, we talked to Tobin Marcus earlier, and he talked about the fact that talk isn't just cheap. A lot of the stuff has to do with policy. When you look at tax policy, that's going to be something that's key to this election, because the Trump-era tax cuts expire at the end of 2025. And both former President Donald Trump and current President Joe Biden have been talking about taxes. Donald Trump wants to talk about lowering taxes. The current president wants to talk about raising taxes on corporations, raising the rate of a corporation that has buybacks, and also a wealth tax, a billionaire's tax, something that isn't likely to get through, but something that certainly is a rallying cry for progressives. One thing we can take away, whether or not it is Biden or Trump in the White House next year, some of Trump-era tax cuts will live on, because President Biden has also promised to not cut raise taxes on those making less than $400,000 a year.
Briefly, Anne-Marie, how will the border play in this? I heard you do an interview earlier on with Congresswoman. Will Biden pull the ripcord on an executive order on the border? Briefly, very briefly.
He's been weighing that decision. I'm not sure if we're going to get him to come out and say that today. What he is going to likely do is what he did when he visited the southern border and invite former President Donald Trump to tell Republicans in Congress to sign up to that bipartisan agreement he struck with senators.
Anne-Marie Hordern, thank you very much for being with us. We look forward to full coverage on State of the Union, the address at 8:30 p.m. That is tonight on Bloomberg. Let's get you some sector price action. These chips are flying higher. Tech is hot. Abigail Doolittle is with me to go under the hood.
Yeah, in fact, all sectors are hot, man. As we're looking at all 11 S&P 500 sectors in the green, the best materials, interestingly enough, so some nice breadth from the tech rally as well. Materials up 1.4%. Then to your point, communication services and technology both up about 1%. The worst sector, healthcare, up nearly 0.2%. So again, bullish sector composition. Let's take a look at the banks, because of course we've had lots of volatility recently with the regional banks in particular. New York Community Bank, that stock is sharply higher. Fitch has affirmed its BB+ rating on the company's capital infusion plans. They also finally have given an update in deposits, probably better than feared, coming in at about $77 billion, just down 5% from the last read at $81 billion. They cut the dividend. Investors seem to think that maybe at least right now it is shored up, and you can see that the overall sector, Manus, is doing well in sympathy.
Yeah, well, that's what you call whiplash, isn't it, Abby? I mean, a turnaround of over 50%. Yes, Abigail Doolittle tracking the big stories for you. Your trading diary, this is what you need to watch out for the rest of the week, and there's not much of it left. Today, the Fed Chair, Jay Powell, testifies before the Senate. Cleveland Fed President Loretta Masters speaking at 11:30 a.m. On the earnings front, we're coming near the end of this quarterly report. Gap and Costco come in after the closing bell, and President Biden delivers that all-important State of the Union address. That is at 9 p.m. Eastern Time. And of course, we're counting down to payrolls number. The whisper number is just over 200,000 for tomorrow. That hits the tape at 8:30 a.m. Equities are bid as we wait for Jay Powell's day two of his communication to the market. The Nasdaq is flying higher. I can tell you this morning it's a lot of the chip stocks that are on the move with real sentiment trading higher there. FTSE 100 up 1/3%, and you also have Deutsche Börse up 0.6% as we've just had the ECB leaving rates unchanged, and the president to the ECB, Christine Lagarde, pushing back hard and resolute that they don't have the data to cut, wages are too hot, and that she will not commit to a cadence and a timing and a rhythm of rate cuts when they come. You need to think about that from a global perspective right here on Countdown to the Open. Good morning from New York.
We're 30 minutes into the U.S. trading day, and it's Thursday, March 7th. Here are the top stories that we're following. More questions for Powell. The Fed chair is taking Congress for a second day of testimony before the Senate Banking Committee this time. And the future of America. President Biden delivers a much-anticipated State of the Union address just days after the presidential race has narrowed. And the ECB holds steady. Expectations met over in Europe, but there are still warnings of price pressures on the horizon. Welcome to New York. Welcome to the Bloomberg Markets. I'm Shonali Bassick in New York, filling in for Katie Greifeld. We are looking at an S&P back on the rise, second day of gains here, and we're looking at a 0.7% rise in that S&P 500 and even further gains in those tech-heavy indices. Think of the NASDAQ 100 up 0.8%, and the SOX Semiconductor Index just flying more than 2%, bringing it on track for a second week, really, of gains here with the rebound you're seeing. The two-year yield only down about 1 basis point today to 4.59 453 on the day. But you remember, we started the week above 460, and we started last week above 471. So some serious cooling in the bond market here, and a bid that has remained into that Powell testimony. Now, we're going to talk about the ECB leaving rates on hold for a fourth straight meeting. Traders are now boosting their bets for a June rate cut as President Christine Lagarde spoke on the path for inflation.
Inflation is expected to continue this downward trend in the coming months. Further ahead, it is expected to decline to our target as labor costs moderate and the effect of past energy shocks, supply bottlenecks, and the reopening of the economy after the pandemic fade.
Now joining us for more is Bloomberg's Alessandra Migliaccio. When you think about the pressures ahead for the ECB and that expectation for even a June cut, how much risk is there baked in based on what we heard from the ECB president here?
So right, we heard from Lagarde that basically, President Lagarde, that basically inflation's doing well, meaning it's slowing. They think that probably by June they'll have enough information. She said we'll have a little bit of information in April. We'll have the main, data that we need to be sure that inflation actually is slowing, that wages are going down as well. It's not just, part of the prices that are going down in June. So the market was predicting a likely June cut. It looks like it's really going to be a likely June cut. Now, how much, for how long that will be going on. And the other question is, what is the Fed going to do? I mean, is the ECB actually going to cut before the Fed? So that's the other question that now, looking forward, we're going to be talking about.
Our thanks to Bloomberg's Alessandra Migliaccio. We thank you so much for your time. Now, President Biden preparing for a consequential State of the Union address tonight, and it comes just days after his rival Donald Trump all but clinched the Republican nomination. Bloomberg's Anne-Marie Horton joins us now with the details here. Anne-Marie, I'm wondering from your perspective, I heard you talk a little earlier about this idea of, are we better now than we were 4 years ago? How do we expect President Biden to address the question?
Yeah, this very famous line Reagan used when talking about then President Jimmy Carter is something that I've heard from both Republicans and Democrats. And when Biden is set to give this speech this evening, what he is going to try to do, not just give a report of the State of the Union to Congress and the American people, but he's going to pivot to the election. And this idea, we better now than we were 4 years ago, he's going to remind people that 4 years ago was March 2020. That's when the World Health Organization said that COVID was a pandemic. And he's going to want to frame that the Trump administration, in his mind, did not put out the correct strategy and policies when it came to COVID. He's going to talk about people going back home. And if he doesn't go on this directly on the offensive with the former president saying the State of the Union, there'll be signals of that as we head towards about this kind of rhetoric ramping up when it comes to November. So he wants to paint this different picture of where we are now than we were under the Trump administration. And of course, he's going to want to highlight what he would do if he got another 4 years. A big part of that for the markets is, of course, going to be tax policy, because the Trump-era tax cuts, they end at the end of next year. And whether or not we get Biden in the White House next year or Trump, some of those tax cuts will still continue to live on, because President Biden has said he does not want to raise taxes on Americans who make less than $400,000 a year. There's a lot of debate, though, and differences between these two individuals when it comes to tax policy for corporations, not just the minimum tax, but also things like buybacks and also a potential Shonali billionaire tax.
Bloomberg's Anne-Marie Horton, thank you so much for your time. We look forward to your coverage tomorrow on Bloomberg Surveillance, and you can catch full coverage of the State of the Union address tonight, 8:30 p.m. Eastern tonight on Bloomberg. Now, as we wait for testimony from Chairman Jerome Powell on Capitol Hill once again, let's welcome back Bloomberg's Michael McKee and Bloomberg's Liz McCormick. We were talking a little bit earlier about how we have seen that bid back in the bond market here. Do you think that to some degree this cooling of rates in the market is conflicting with the path and the message that Jerome Powell is trying to set across here, Mike?
Oh, I don't think so. I think basically what you got is the market reacting to events today in the European Union, the Euro area, with Madame Lagarde talking about rate cuts, maybe putting more of a date on it than Jay Powell has done. Also, some economic data today that showed the market that the economy is sort of status quo at this point. We're still 10, 15 days out from the Fed meeting on March 20th, and the Fed has already told us they're not going to do anything then. So what we're really talking about when you're talking about markets and the Fed is May meeting, May 1st, and that's still such a long way away. I don't think that we're really trading on what the Fed's going to do on May 1st.
Now, Liz, how are traders positioning? We talked about this a little yesterday on the long end of the curve. Powell did get some awkward questions yesterday when you thought about the balance sheet reduction. How do you expect him to answer it today?
Yeah, and in fact, I hope there's more questions on that. As you know, yesterday's focus was a lot, which is important on prudential regulation. But yeah, I suspect maybe we'll get some more macro questions. And on the balance sheet, you know, the yields, like you said, went down across the board yesterday, you know, because people feel like even he was kind of just hawkish enough, not too hawkish, continued to lean into that we're going to have rate cuts sometime this year. He doesn't know when. But yeah, I mean, we're still looking to get more insights on could he, you know, talk a little more on when's their plan to start tapering how much QT they're doing. You know, that's debt rolling off their balance sheet. There's a lot of focus in the market that they'll kind of reduce the amount they're rolling off starting maybe in June and then maybe be done by the end of the year or early next year. That kind of connects to how much issuance the U.S. Treasury Department has to do because, you know, when the Fed, you know, is letting debt roll off, that kind of adds on the margin to what they have to borrow from the public. So there's a lot of moving parts for the Treasury market, but yeah, we'll be watching that. We didn't get that much yesterday, but we're hoping to get some more today.
Now quickly here, Mike, too, we barely got any questions yesterday when you think about really the regional banking system. I was kind of losing my mind when I was watching these New York Community Bank headlines and Powell's testimony at the same time. Do you think he'll get more questions on that today, given the capital infusion that we've seen?
Oh, he might get a question or two on that, but you have to remember the Fed does not regulate NYCB, so he doesn't have a specific dog in that fight. The issue would be for the Fed whether there's a systemic problem, and the general feeling there is not, that this is a sort of unique bank situation because of their portfolio, because of their construction, and now they do have this cash infusion that may keep the problems very much isolated to the bank and let them work out. He said yesterday that he does expect some CRE problems among banks and largely among smaller banks, but he thinks those will also be worked out. There may be some losses, but there will not be a systemic problem from that. He did say it would take some time, maybe years, for all of these CRE issues to be worked through. But overall, the Fed is not concerned at this point about a kind of systemic thing that we went through in the 2008 period and then almost went through last year at this time.
You know, it's interesting. It's kind of become a cocktail party conversation, the Basel III endgame, if you will, Mike. The fact that he kind of hinted at the loosening of some of these rules here, do you think he'll get some serious pushback from the likes of Elizabeth Warren?
Oh, you just set me up for that one. Of course, she's also complained about high interest rates hurting the housing market. So in her 5 minutes, her remarks are they could go either way. But I suspect she will land on the Fed chair for the idea that they might roll back some of these Basel tightening regulations and raising capital standards proposals. And if she does, that'll make some headlines, but it's probably not going to change the Fed's mind. Interestingly enough, Sherrod Brown, the chairman of the committee, who has also wanted stricter banking regulations, didn't really touch on that all that much in his opening remarks. He spent much more time talking about the need to lower interest rates to improve housing and the fact that inflation is because companies are greedy rather than anything else at this point.
Liz, you know, this is a very highly watched testimony. There's a lot at stake from regulation to the direction of interest rates moving forward. What are bond traders looking for in this second day of testimony, particularly knowing that we still have that payrolls report at the end of the week?
That's what I was going to say. Traders are going to be careful to not go over their skis too much today because we have payrolls, and then we have Tuesday, the next CPI report. So there's a lot of data on the hopper for them, even if, like Mike said, the Fed's going to do nothing in March. But I think traders are looking, there was kind of one question about the so-called dot plot, their quarterly forecast, and, Powell mentioned that, hey, the last one is a few months old and it's not an exact prediction. But I'd like to see if there's some more on exactly pacing that they might do for cuts once they start. I think traders would like to see some insights on that. We may not get it, but it would be nice to get some more details.
Yeah, it's interesting. When we think about the data that we're getting in the coming days and weeks, is there anything that the Fed chair has said, Liz, that would point traders to certain types of data more than others at this point?
Yeah, I think what's interesting is he's kind of, continued to stress both mandates. Of course, inflation, getting that back, confidently towards their 2% target is most important. But he's talked about the dual mandate. He was pressured yesterday a little bit about the economy and rates being high. And I don't think he wants to. He was asked to define a soft landing, and he wouldn't. But he said there's no data that really shows we're having a recession. So I think he's looking at everything, the jobs data tomorrow, from the actual numbers to the wage numbers, and then CPI. They're trying to get this, I think it's Austin Goolsbee calls it like this golden path of getting inflation down and not, turning the economy on its head. So I think he's saying we're going to look at everything. We're going to take the data, and so that makes it harder. And my colleague Mike McKenzie reminded me that blackout period starts on Saturday. So it's going to be a lot of data next week and no more Fed speak. So I think people are hoping to see what they can get from Chairman Powell today and any other speakers through the rest of the week.
Yeah, it's interesting, Mike, as we watch the Fed chair really speak to Congress at this point in time in D.C., we have to understand there are other Fed speakers elsewhere, including Loretta Mester today. Where else are your attentions?
Well, to the extent we get additional Fed speak, I think the questions are going to be asked of members of the Open Market Committee about the SEP, the Summary of Economic Projections, and the dot plot, and whether they think any changes are justified. Raphael Bostic said earlier this week that he thought maybe he might dial back his prediction for Fed rate cuts. And if we get a couple more of those, that could change the dot plot, and then you've got a new plot for the markets to figure out. But beyond that, I don't think you have a whole lot going on. I don't think Jay Powell's going to give us a lot of direction in that regard today either, but that's kind of what you would look for at this point.
Bloomberg's Mike McKeon, Liz McCormick, a busy couple days ahead and a busy couple hours. We're going to go now to the Capitol Hill where Fed Chair Jay Powell is testifying to the Senate Banking Committee.
Why shouldn't the Fed act now to prevent workers from losing their jobs rather than reacting after the fact?
So we're well aware of that risk, of course, and very conscious of avoiding it. And what we said is if what we expect and what we're seeing is continued strong growth, a strong labor market, and continuing progress in bringing inflation down, if that happens, if the economy evolves over that path, then we do think that the process of carefully removing the restrictive stance of policy can and will begin over the course of this year.
I mean, I know we've had this conversation publicly here or privately also that, working people are hit the hardest with inflation. They're also hit the hardest when companies try to cut costs with layoffs. This town too often seems to forget that maximum employment is part of the Fed's dual mandate. Let me ask you about bank supervision. Senator Scott mentioned that. Last year's bank failures illustrate the need for strong oversight. SVB grew too big, too fast. Fed supervision didn't react decisively enough. The Fed, in response, undertook an assessment of its supervisory process to identify and address gaps related to the speed, the force, the agility, if that's the right word, of its supervision. Explain what concrete steps the Federal Reserve's taken to strengthen supervision and any specific areas where work to make improvements is ongoing.
So this is a very broad area of work. There are, many people in the Federal Reserve System who are involved in supervision, thousands of them, and there's a rule book, and so there's been careful study and thought and a lot of listening to understand how we can meet those goals of being quicker and more effective, basically is how I would say it. If you look at Silicon Valley Bank, we weren't quick enough and we weren't effective enough where we were in. And so we're working hard to develop a new rule book and another set of practices which is still going to be evidence-based and fair, but it's going to involve earlier interventions and more effective ones. And you know, I think this is work that's ongoing and will be for some time.
Thank you. The job of the Fed, of all public officials, is to serve the American people, not their stock portfolios. We've seen abuses in this body. We've seen abuses at the Federal Reserve. I wrote to you last month asking the Fed to identify substantive penalties for board officials who violate the trading rules. Where is that in the process? And I expect these rules in place before the next monetary policy hearing in 6 months. Where is it?
We got our own Inspector General gave us 6 things to work on. I read the list from beginning to end, and the 6th one was what you said, and I just said, we're going to do all of these. Let's get going. So we've done 5 of them, and we're working on the 6th.
And it will be finished within 6 months when you're back?
I want to get it right. I certainly hope so, and expect so.
Expect so is a better answer than hope so. One last question. More and more, many companies use algorithms that combine competitors' price information to engage in what they call dynamic pricing or surge pricing. You know that corporate PR teams worked hard on this. Just another way for corporations to make it harder for consumers to seek out lower prices and to pad corporate profits. Are you concerned that the wide adoption of these price gouging strategies, these pricing schemes, if you will contribute to inflation?
I mean, I think it works both ways. Let me say this, you know, we're well aware of this trend and we're monitoring it. Remember that prices go down when there's no one in the store and they go up when there are a lot of people if you're doing dynamic pricing. Same thing with the ride companies. It works both ways. I don't know that it have implication for, you know, for inflation. It would certainly have implications for consumers who need to be informed.
You think that this kind of surge pricing might lower prices overall?
I mean, that's my understanding is that the idea is that in slow periods, prices actually go down, and in busy periods they go up.
But these are sophisticated economists working for these big companies, and they're not going to do things to lower their profits.
I think the price mechanism is incredibly important in our economy. I think we need to give companies the freedom to do that as long as they're not fixing prices or failing to disclose the nature of the price changes to the public.
I have a few seconds. Research has indicated constrained supply was behind a significant amount of the inflation we've seen over the last few years. If the supply chain, for instance, of autos had been more resilient, or if there had been more housing availability, would that have made your job easier?
Yes, in a word. Yeah, a big part of the inflation was, and we saw it in 2023 when the supply chain problems unwound and when the labor supply shock that we had unwound as well, we saw inflation come down very quickly in the second half of the year. But it's also down to tight monetary policies playing a role as well.
Which leads me to the plea with you to speak out about inflation, about the contribution of corporate profits and greed to inflation. Thank you.
Oh, I know you are done. That's true.
Mr. Scott.
Well, I was
Find yourself agreeing with me more and more often? Is that what?
That would be a nightmare, and I'm awake. So what I would say, however, is that the fact of the matter is that so often, if in fact 60%, I actually listened to what you said, which was remarkable. The fact that 60% of Americans today can't afford a $1,000 emergency, I can't imagine how the average millennial affords a down payment for a home. I can't imagine how they take into consideration when they're looking at a snapshot of their financial future, fixing and repairing or having a plan for obsolescence that happens for every homeowner in the country. I think the issue is far more complicated and would love to delve into that over the next 4 minutes and 18 seconds. But my first question is a combination between the challenges of illegal immigration and crime. It seems like every single week there's another story of another city underwater attempting to feed and house millions of illegal immigrants, and American taxpayers are footing that bill. Like I mentioned in my opening statement, just recently in Denver,
we saw city workers having their hours essentially zeroed out so that the city could allocate more resources for the illegal immigrants. In San Francisco, they say that the average cost between San Francisco and Oakland, because of crime, is almost $4 billion. Couple that with, in New York, you see Governor Hochul bringing out the National Guard and the state police to help reduce the impact of crime. At the same time, Mayor Adams says he needs more money because the state of affairs from illegal immigrants in the city is devastating the economy, scaring the citizens, and reducing the opportunity for business as usual to return to New York City. So my question is, can you explain how our economy is expected to continue shouldering the burden and the costs because of illegal immigration? And what, if any, information do you have as it relates to the impact of this surge of crime in our major cities on the economic outcomes of those cities? Because I heard the discussion that when you have more folks in the store, you have more shoppers, except for these days, when you have more folks in the store, sometimes they're just there to steal.
So you quoted my statement earlier, and it was an accurate quote, for which I thank you, but I would say right before that, what I said was immigration policy, very important, very much under discussion, and it's none of our business. We don't set immigration policy, and we don't comment on it. So.
But you commented on immigration. So my point, though, is that when you're going to tell a story, please tell the whole story, especially when the nation is frustrated by nearly 10 million folks by the end of this year coming into the country and having the kind of negative impact on prices, on crime, on the challenges that everyday Americans, especially Americans living in the poorest parts of America, face on a daily basis.
So as you accurately quoted, I said over time, so I was referring to the history, which with you agreed. So I was staying as far as I possibly could from the current political context. And, you know, it's really not appropriate for us. We're independent. We like to remain that way. And the way we do that, one of the ways is by staying out of political issues that we really aren't assigned. And so the kinds of issues you're talking about are very, very real. I don't deny that, but they're really not for us.
So the Fed does not consider the impact of 10 million illegal immigrants coming to our country and the costs associated with those illegal immigrants, nor do they consider the impact on states like New York or California or Illinois, where the devastation of crime ravishing the poorest Americans has an impact. We don't take that into consideration.
So we do. And so does the Congressional Budget Office. We do try to estimate population, and we try to estimate the effect of immigration, legal or illegal, on the size of the workforce and on GDP. If you look at the Congressional Budget Office has, as you probably know, a detailed assessment of all the things like that. We don't really have a way, and we do look at the finances in the aggregate of state and local governments, and the hiring that they do. So that's something we look at, but we wouldn't do a very specific assessment like that. I mean, CBO probably would, but we wouldn't do that.
Thank you.
Mr. Scott, Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Before I begin my questions, I want to celebrate that in the past year we have seen the first Latino Federal Reserve governor and the first ever Latino Federal Reserve Bank president. These are historic milestones that show we are finally making progress, something that I have been at for quite some time, to the leadership of our economic institutions. So I want to applaud that. And Mr. Chairman, I hope that progress can continue and extend to the rest of the Federal Reserve staff.
Thank you.
I agree with my friend, the ranking member, that when you tell a story, you should tell the whole story. Mr. Chairman, are you aware of the Washington Post February 27th article that says the economy is roaring and immigration is a key reason?
I don't recall that, but I would have read it.
Let me read it to you. Immigration has propelled the U.S. job market further than just about anyone expected, helping cement the country's economic rebound from the pandemic as the most robust in the world. It goes on to say, economists and labor experts say the surge in employment was ultimately key to solving unprecedented gaps in the economy that threaten the country's ability to recover from prolonged shutdowns. Would you take issue with those statements?
You know, there are a lot of adjectives and adverbs in there that you wouldn't see in Fed world, but the
take out the adjectives and give me on the substance.
The story is, I think, broadly that it is that there was a very significant increase in the size of the workforce last year, and it was happening all during the year, and we were wondering what it was, and the answer was it was really two things. It was labor force participation, but it was also immigration. And if you look at the Congressional Budget Office numbers, it kind of makes sense because there was a lot of growth. Wages were coming down. The economy is bigger. And those are probably in part affected. This is without making any judgments on immigration or immigration policy, but I think that's an economic fact.
I'm not suggesting that. I'm just suggesting the facts are that we had 10 or 11 million jobs that were going unfulfilled in our economy. They lacked the productivity that is necessary for success economically. And as part of that, clearly, immigration helped fuel part of our revival coming out of the pandemic. In fact, those were the people who were the essential workers when the rest of us were staying home. So I agree we need to do what is necessary to have a regularized border, but I also think that just to create the context of immigration as a scourge is absolutely wrong. Let me turn to another question. In my view, the sticky inflation we've been seeing in the housing sector is principally due to the massive nationwide housing shortage. The Fed's monetary policy report attributes the shortage to restrictive zoning, high interest rates, and tighter underwriting by banks. I would also add to that list underfunding of key HUD programs that shore up and expand our supply of affordable housing. If the housing supply shortage continues to grow, are we likely to see continued housing inflation?
Yes, we are.
And housing is already becoming less and less affordable for low and middle-income Americans. According to the National Low-Income Housing Coalition's 2023 Out of Reach report, a worker earning the minimum wage in New Jersey would have to work 2 full-time jobs to afford a modest one-bedroom rental home at fair market rent. Do you agree that increasingly unaffordable housing is a problem for the economy?
I think there are two things going on. One is a longer-term housing shortage, and the other is the pandemic effects and the associated higher interest rates, which are things that will pass through. When all that passes through and rates are normalized, we'll still have the underlying housing shortage, and it's going to be causing upward pressure on housing prices.
Now, the monetary policy report noted that, quote, home purchases by low-income households have fallen disproportionately more because mortgage lenders impose maximums on the ratio of a borrower's debt service payments to the borrower's income. I'm worried about how this dynamic will interact with the recently proposed capital requirements proposal, which, according to analysis from the Urban Institute, would disproportionately increase the cost of mortgages for Black, Hispanic, and low-income moderate borrowers. Given this, isn't there a risk that if the capital rules implemented without changes, that it could make it even harder for disadvantaged borrowers to attain home ownership?
There is a risk like that, and we're very focused on it.
And hopefully you're working to mitigate it.
Yes.
Thank you. Thank you, Mr. Chairman.
Thanks, Chairman. Senator Rounds from South Dakota.
Thank you, Mr. Chairman. Chairman Powell, welcome back. First of all, I've appreciated the way that you've approached the discussions in front of this committee, and I understand your desire to stay as neutral as possible with regard to the politics involved in an election year. But I do have some questions here, specifically with regard to the Basel III Endgame proposal. An analysis of that proposal found that 97% were either opposing it or expressing substantial concerns. In the hearing last March on the Monetary Policy Report, you stated that the Federal Reserve is a consensus organization, and you said, and I quote, I will do everything I can possibly to bring people together in consensus and have a capital framework that could be broadly supported. My question to that is, do you currently believe that there is a consensus on this capital framework?
I believe that we will have one. I'm fairly confident that we will have such a consensus when we do move forward.
So we could expect that you will probably not call a vote on the proposal until you believe that there is a consensus?
I think that's right. I mean, we're just in the process of digesting the comments and then making the appropriate changes.
Thank you. As you are aware, I've weighed in several times on the concerns that I have with regard to Basel III Endgame, including I'm concerned about the lack of transparency, the negative effects on mortgage lending and home affordability by disincentivizing banks from offering high loan-to-value loans that primarily help first-time home buyers and low to moderate income borrowers. I'm concerned that the proposal will make buying a home harder than it already is for many. And further down the road, I fear that it could disincentivize mortgage lending from the largest banks, particularly with regard to the secondary market and their impact on even smaller banks that do business with them. Would you be willing to withdraw the proposal or re-propose with significant modifications, particularly addressing the concerns that I and others have on this committee, raising specifically with regard to the impact? And I'm thinking of Freddie and Fannie in particular and what the impact might be. What would you see as the process involving those particular issues?
So on those issues, we're well aware of and very focused on those issues. We haven't decided what to do about that yet, but we get it on those issues. In terms of process, we're not at the stage of making that decision. I will say if it turns out to be appropriate when we get to that point for us to repropose parts or all of the thing, then we won't hesitate to do so.
Okay, thank you. Makes me feel a little bit better because I do think there are some very serious problems that would occur if the Basel III Endgame as proposed goes into effect, and I most certainly am hoping that the Federal Reserve will find a consensus on this, and it sounds like that may very well include some significant modifications if it were to be brought at all. Is that a fair statement?
I expect there will be material and broad changes to the proposal before it comes back to the committee for consideration, the board for consideration.
Thank you, sir. Let's just, with regard to the economy today, a limited level of price growth is believed to help facilitate economic expansion, reduce the risk of recession, and help businesses and consumers plan. However, during the Biden administration, we saw inflation climb to 13%, and those prices are now the new norm. I know that you make it a policy not to comment on the administration's fiscal policy, but it is well known that I really do believe that high inflation and high prices have been a direct result of President Biden's policies, failed in many cases, that the Federal Reserve has limited tools to address some of the problems that these policies created. We talk about supply side versus demand side on these costs. What have been some of the unintended consequences from raising the federal funds rate as rapidly as you felt that you had to as the chair and as the committee? What are some of those? I know that we talked a little bit about SVP and the failure there, their inability to look at treasuries and the increasing interest rates and so forth, but can you talk a little bit about some of the things that you've seen that were negative with regard to trying to respond to those high inflation rates?
Yes. So high interest rates are hard for businesses, they're hard for people. They're the thing they're the tool that we have to use to bring inflation down. And our job at this time, when high inflation comes, it is the Fed's job to restore price stability, and that's what we're doing. You point to the losses in banks. That was a very substantial thing, and obviously the supervisors, and that was us, didn't get to that problem. We were aware of it, but we didn't probably appreciate it enough. Another surprise, though, is that we were able to get this far and get inflation down this quickly without seeing a big increase in unemployment. And that's just a great result. That's just a surprise. It's not consistent with the historical record, but it's a really positive thing.
Thank you. And I would just know the only tools you had available were demand-side tools.
Yeah, that's right.
Thank you. Thank you, Mr. Chairman.
Thank you.
Senator Warner of Virginia is recognized.
Well, thank you, Mr. Chairman. Chairman Powell, it's great to see you. I would point out to my good friend from South Dakota, I do think, if we'd gone back a year to 18 months ago, nobody would have predicted a soft landing. And I know you're not ready to declare victory by any means, but the fact that inflation has come down, I actually think some of the things like the CHIPS bill, the infrastructure bill, and some of President Biden's policies have actually kept the economy growth rate at the levels that have allowed you to bring down inflation without seeing a dramatic rise in unemployment. And again, that'll be something we'll probably have the opportunity to litigate over the next 8 or 9 months. I want to take my time on issues around less about monetary policy and more about regulation. I think we can never presume that we're out of the woods on financial stability, as we saw with the New York Community Bank yesterday, the stock plunge and the capital infusion. One area that I raised with you a year ago, I want to re-raise today, and that is non-bank lending. The fact that non-bank lending in terms of to non-financial firms now is actually exceeding regulated bank lending. And let me be clear, I've got, the non-bank financial sector has done productive things in our society over the years. But when folks like former New York Fed President Dudley and former Fed Governor Grosvenor recently said that they had worries about this reliance on the non-bank financial sector could lead to overall economic lack of stability. I guess, what do you think? I've got a 3-part question. What do you think are the risks as we see this push-out effect of more and more lending going outside the regulated perimeter to the non-bank sector? How much do we really know about these institutions? And one of the things, they have very smart, sophisticated investors, but if those very smart, sophisticated investors said, well, hey, we don't like the lending profile right now, and we want you to not make any additional loans for the next 6 to 9 months, do you think our system would be able to pick up the slack?
So we have the regulated banking system where you've got a lot of transparency, you've got deposit insurance, you've got access to the discount window and all those things. Regulation. If you go outside that, most of the funding that we see now in these vehicles is sophisticated investors who are actually limited partners, meaning they can't pull their money out. They've signed a contract, they've funded these deals. And so what you see now in the non-bank financial sector is significantly, it's that kind of thing. So it doesn't have the run risk. The point is, the bigger it grows and the more diverse it gets, it is happening outside the regulatory perimeter, and you worry that when there is another crisis, you'll be surprised, but there will be ways that financial structure too can break down, and it does break down in ways we don't anticipate. So I think we need to be smart about the way, intermediation is absolutely moving out of the banks into the capital markets and into non-bank financial institutions. That's what's been happening for a long, long time. I just think we need to be thoughtful about understanding where the risks are emerging.
And that sophisticated investor may rightfully say, hey, we don't want you to lend anymore for a X period of time, but that may then, at that moment of crisis, mean that the lending capabilities completely dry up. And one of the things I never completely understood until I got a little better explanation recently, why the large regulated banks weren't more complaining about this non-bank lending. But as I got to understand a little bit more of the, and again, I'm not per se criticizing on the non-bank lending, but many of the regulated banks actually lend to these large institutions, so they make money off of those relationships, and maybe that's again an explanation of why they're not being more critical. I only got 40 seconds left, but I would like to come back to another thing that we've talked about a lot, and that is the question of use of the discount window. I believe one of the original tools that the Fed had, I know banks say, well, we're concerned about the stigma. I've got some legislation that would actually require mandatory use of the discount window. I'd love your comment on that. And also just the idea that having the mechanics of the discount window open, potentially even 24/7, because we saw with SVB, they didn't know how to use it, but two, if they wanted to use it in the non-bank hours, could they get access?
There's a lot of work to do on the discount window. You're absolutely right. It needs to be brought up technologically into the modern age. We need to do more to eliminate the stigma problem, and we need to make sure that that banks are, actually able to use it when they need to use it. And those things, that's a broad work program that we're on right now, and it's very important.
I know you're working on it, but I would look forward to working more, and I'd invite other colleagues. I really do think before we start adding a whole host of the other regulatory issues, we ought to use some of the tools that are out there. You're not gone. So
God, I just checked in at the Veterans Committee. Senator Tillis, North Carolina. Thank you, Mark.
I was about to take control, Senator Warner. Welcome, Chair Powell, and Gus sends his regards. If you have time after the hearing, you ought to go by and see him. He's a dog in our office. But
I don't want to disturb his nap, but
but thank you for being here. I want to get back on this Basel III proposal. Senators Lummis, Coons, Gillibrand, and I sent a letter indicating our concerns with the current proposal. But I think it's also worth noting that the number of other organizations, a diverse group that are not normally aligned on policy. You got Bank Trades, National Housing Conference, NAACP, Habitat for Humanity, National Community Reinvestment Coalition, the list goes on, who have concerns with the current proposal. Here's my concern. I think we're trying to make the best of what was foundationally a bad proposal. And so I'm in the category of people who think that it should be reproposed, because I think one of the reasons why I did not support Mr. Barr's nomination is I felt like we were going to be here. I mean, it was pretty clear to me before he ever got confirmed on the board that we were going to be in this place some months or years later. And here we are. And I think that the industry felt the same way. All of these stakeholders, some of them are in banking trade, some of them are on the other side of the spectrum. So I'd like to cast my vote or provide some weight to the idea that we should repropose it. And what we ought to do is talk about the reality of increasing capital, or the prospect of increasing capital requirements doesn't concern me. I think the prior Fed supervisor had made comments publicly that maybe we needed to raise capital standards. But what we did here in this proposal, and I heard in that dialogue, is let's deal with puts and takes. Let's talk about raising capital requirements, but let's also talk about reducing the cost of the regulatory burden today if we can do it responsibly. There's no evidence of that in the current proposal, and I think that may actually produce a different set of comments that would be instructive to a final proposal that I think realistically will include some increase in capital requirements. So over what time horizon do you think we would expect to either try to make the best of this foundation or go back and take a look at a new foundation and repropose it?
We're going to work through it as quickly as we can and should. I will say it's more important to get it right than it is to do it fast. We're not in a hurry. But my guess is we'll work this out over the course of this year.
Yeah. Well, if you take a look at the outsized cost of operational risk, the long list of concerns that I have publicly and privately expressed on the current proposal, I do think sometimes it's easier to knock down what I think is a poor foundation and build a better house. So again, just wanted to make that comment publicly. I got a question about shrinkflation. I tell you, some of these words that we come up with, but President Biden's using the idea of shrinkflation and chastising manufacturers for creating smaller portion sizes for potato chips. I'll use that as one example. But if you have rising input cost and you're not able to control that, and you're in a marginal business to begin with, and now you're saying you can't even reduce the quantities, how does a business that's not making a profit make that work?
I mean, we see inflation at the aggregate level as a mismatch between supply and demand.
Yeah.
And as we've seen supply get better and we've seen demand cool off a bit, it was very hot coming out of the pandemic. We see inflation coming down.
We saw food inflation between 2010 and 2021 at 18% over 11 years. And over the last 3 years, we've seen it at 21%. I think that we have a industry that's trying to actually provide products that consumers want, and now they're being chastised for trying to figure out how to make the numbers work. So this whole idea of shrinkflation is just confounding to me. I'm going to submit some for the record. I want to stay on time. But I have a question. I think the chair mentioned, if I misunderstood this, I'm sure the chair will clarify, but I thought in his opening comments, he suggested that stock buybacks and paying out dividends were a key factor in inflation. Do you, as just a matter of policy, see stock buybacks and dividends as one of the top 5 reasons we're experiencing the inflation we have right now?
First, I guess I see stock buybacks and dividends as just the same thing in a different form. And I don't know, I wouldn't comment on anything the chair even may have said.
Yeah. Well, I'd
like to avoid that.
I don't think, I'm not going to ask you about policy because I think you're consistent on that, but I just can't imagine that if we decided to outlaw stock buybacks and dividend payments, that would have a material effect on inflation. So I'm not going to ask you to respond to that, but there are some people that by inference you could assume that they think that would be helpful. I just, for one, I'm not an economist, but I just can't imagine that it would be, one of the things that would make your job easier. Can you at least opine on that?
Banning stock buybacks and dividends?
Yeah.
Yeah, I think that would be quite a change in our capital markets.
Yeah, me too.
I mean, shareholders, this is just money going back to shareholders from companies that have nothing to do with it.
Okay, thank you, Mr. Chair.
Well done, Senator Tilley. Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. And thank you, Chair Powell. It's great to see you here again. I appreciate your testimony. And I'm going to focus my questions on housing and housing affordability. As you have well pointed out, overall prices have moderated considerably since the Fed began raising rates, yet housing costs have remained stubbornly resilient or high, leaving us really no closer to addressing the affordability crisis that I think that we have, and this was there well before the pandemic. Shortly before the Fed began tightening, Chair Powell, and you came before the committee, I asked you about how higher interest rates could exacerbate this unaffordability problem that we have by making mortgages more expensive and also hindering housing development. And I think that at the time you argued that we have a excess housing demand during the pandemic, and that was kind of at the root of higher costs, and that your goal, the Fed's goal, was to bring demand closer in line with supply. So my first question is this. So the housing market has cooled significantly over the last 2 years. Is it your view that it has cooled enough so that housing supply and demand is better in balance? And following on that, given the Fed's limited tools, understanding that, at what point will you think that you've done all that you can to lower housing demand? My view is that we're well past time in Congress to take action on the housing supply side, but I'm interested in how you see this dynamic.
So we're not focused so much on housing and housing inflation. We're really focused on the aggregate, which is also goods and non-housing services. That's way more than half of the PCE inflation. There are things in the housing sector that we didn't fully anticipate. One of them just was that people in very low interest rate homes with very low interest rate mortgages aren't selling.
Right.
So the quantity of homes that's available is incredibly low, and that's why it's very little in the way of existing home sales, and that drives up existing home sale prices, but also new home sale prices. So again, there's two sets of factors. It's the longer run issue, but then there's the factors associated with the pandemic and the inflation and our response to it. I think as the overall inflation continues to come down and rates then come down, you'll see the housing market start to heal and get better, and housing affordability should go up again. But you're still going to be left with the longer term problem of supply.
Right. I think that's right. I mean, what I see in Minnesota is that higher interest rates are, of course, driving up the cost of construction. They're driving up the cost of mortgage rates. You're seeing people who aren't leaving a house that maybe is a little too small for them because they can't afford it, that the housing, just as you're saying, people are staying in their homes longer. And so there's sort of this double whammy of construction slowing at the same time that there is this great need to address housing supply. One of the things that is happening, it's interesting, a recent analysis by Zillow found that the monthly mortgage payment on a let me get this right. A recent analysis by Zillow found that the monthly mortgage payment on a $343,000 home, assuming 10% down payment, is about $2,200 a month. Okay, so $2,200 a month. That means the cost of owning a typical home is higher than 30% of median income, which is kind of the measure of affordability. And so we've got a lot of issues with people just being priced out of the housing market. So from where I sit, the cumulative issues of higher mortgage rates are just really a challenge, and until we can get to the bottom of that, we're going to have a hard time addressing the housing affordability challenge that we have. Would you like to comment on that?
Yes, I agree with all of that. I mean, home prices don't actually go into the calculation of inflation. It's really rents and owner's equivalent rent. But I agree, the housing market is in a very, very difficult situation. And, the sooner we can get back to price stability and restore interest rates to lower levels, the sooner it can start healing.
Yeah, thank you. Thank you, Mr. Chair.
Thank you, Senator Smith. Senator Kennedy of Louisiana is recognized.
Mr. Chairman, thank you for being here. Thank you for your services. I think I've said before, I believe you and your team probably saved the world economy during the pandemic economic meltdown when the whole world wanted dollars by establishing the currency swap line. So I thank you for that. You gave an interview, Mr. Chairman, on February 4th of this year to CBS, 60 Minutes, I think. Is that right?
Yep.
I ordered a transcript of that hearing, which I read. I learned a lot reading it. You were asked a question about inflation, and you asked a question about prices declining. And here was your response. I'd like to quote you, if it's okay. Quote, "So the prices of some things will decline, others will go up, but we don't expect to see a decline in the overall price level. That doesn't tend to happen in economies except in very negative circumstances." End quote. Did I quote you accurately?
I believe you did.
Okay. Later in the interview, you were asked about the national debt. Do you recall that?
I don't actually, but I'm sure that's right.
Okay. Well, at least according to the transcript, your answer was, and again I'm quoting you, "In the long run, the United States is on an unsustainable fiscal path. The U.S. federal government's on an unsustainable fiscal path. And that just means that the debt is growing faster than the economy. So it is unsustainable." End quote. Do you remember saying that?
I've said that many times. I think that's uncontroversial.
Okay. Later in the interview, you said, I want to quote, "I would just say this, integrity is priceless. And at the end, that's all you have. And we plan on keeping ours," end quote. Is that an accurate statement?
Yes, it is.
Okay. That's why I want to ask you about the FDIC. Have you read the article in the Wall Street Journal entitled, quote, "Strip clubs, lewd photos, and a boozy hotel, the toxic atmosphere at bank regulator FDIC," end quote?
I think I did read that a couple months ago.
Did you read the article entitled, I quote again, "FDIC lawyer stayed on paid leave for weeks after child porn arrest," end quote?
I don't remember that one.
Okay, did you read the article entitled, also in the Wall Street Journal, quote, "FDIC chair, known for temper, ignored bad behavior in workplace," end quote?
Honestly, I don't. I read so much. I can't. I remember the broad story, but not particular stories.
Did you read the article in which a former female employee of the FDIC allegedly recalled her male colleagues saying women needed to use sex to get ahead at the FDIC?
I do not recall that, no.
Okay. Did you read the article in which a female risk management examiner during a lunch with a male examiner said she had become friendly with that examiner, and he complained to her about his marriage, allegedly, telling her he wasn't getting enough sex, and she allegedly said, quote, obviously if I walked, or he allegedly said, obviously if I walked into this office and you were naked, I'd fuck you right here, end quote.
I do not remember that, and I think I would.
Okay. Do you remember the article about Mr. Randall Ditch, a supervisory examiner in Denver, who allegedly was demoted in 2014 to a non-supervisory examiner position in Tulsa after having sex twice with a subordinate female employee and a number of other rule violations? In this article, it says, allegedly, Mr. Ditch had urged the woman to not, quote, be a pussy, close quote, and drink a shot of whiskey during work hours, the records show. Do you recall that?
I do not recollect that. No.
Here's my question. I could go on for a while.
Could go on, but you're not going to go on, so you've passed your 5 minutes. Do your question once.
Sir?
Senator Kennedy, your time's already expired. You can do one. You did 5 minutes, consumed the whole 5 minutes with your monologue of...
Well, you did 6 minutes. I timed it.
I asked my...
You did 6 minutes.
Senator Kennedy, for months, I have let you go way over the 5 minutes. You get your question.
But you did 6 minutes.
I chair this committee.
I understand. You still did 6 minutes. Check the record.
I'm going to order, you're going to be at 6 minutes and 15 seconds if you continue this argument, or you're going to ask your question.
I'll ask my question. I just wanted the record to be clear, Mr. Chairman. Mr. Chairman, in light of these allegations, if they're proven, how can the FDIC lead this charge for Basel Endgame 3, which is going to turn the banking community upside down?
I don't know how I would make the connection to Basel III. I'll say it's deeply troubling things, obviously, but again, you know, as your point was, if proven. And I mean, I think we have to decide Basel III on its merits, and we're not looking to the FDIC to lead this, by the way. We're looking at the Fed to do what the Fed thinks is right. That's what we're going to do. We don't look to, and they don't look to us to lead them.
Thank you, Chair Powell. Senator Butler is recognized.
Thank you, Mr. Chairman.
Thank you.
Senator Butler is recognized.
Thank you so much, Chair and Chair Powell. Good to see you in person, and thanks for the time to talk. I want to pick up a little bit where Senator Smith was in relationship to housing affordability, and hopefully draw a little bit on the point that you were making about rents. It definitely is an important crisis in my state of California, and I know across the country, where, at least according to the California Department of Housing and Urban Development, renters in San Diego are paying about 50% of what is, they're spending more than 50% of what is considered affordable, and statewide, the majority of renters, more than 3 million households, are spending more than 30% towards rent. Nearly 1/3, more than 1 in 5 million households pay more than 50% of their income towards rent. And the Chicago Fed President Goolsbee even referred to housing as a missing piece of the puzzle in the Fed's path to lower inflation. So, to the continued conversation, and I know a point that you've made that about how inflation has a disproportionate impact on lower income households who are focused on spending more of their monthly budgets on housing. How is the Fed's monetary policy impacting the supply of affordable rentals?
I don't know that we're affecting the supply of affordable housing. If you think of affordable housing as something that's connected to some sort of government program, that's not our bailiwick. I mean, clearly interest rates do affect the affordability of housing, though. And
there was a key point that you made in an earlier I think, reference about, and in your response to Senator Smith about the monetary policy and the calculation of rents. Can you just spend just briefly talk about that? I have one last issue I want to get to before I run out of time.
It's hard to talk about it briefly. It's actually very conceptually challenging to think about housing inflation. Do you include the costs of financing it? Do you include the sale prices? And the answer is we don't. We convert ownership into an imputed rent, and that's 2/3 of homes are owned. And then we actually measure rents, but leases only turn over once a year, so you look at market rents, and what's happening with newly signed leases may be very different from what was happening a year ago. So it's complicated, but the good thing is we understand all that, and we look through that. We look at housing services overall as one of the three important categories, along with non-housing services and goods inflation.
Thank you for that. In the line of affordability and housing, again, sort of very general, I think, to the broad monetary policy and state of our economy, and unique to California. And I raised this with Secretary Yellen when she was here as well, the insurance gaps that are presenting themselves due to the impact of climate change. Where 1 in 5 residents in California live in areas of that risk flooding, and all 58 counties have a history of flood damage. And we are seeing more and more insurance providers, home insurance providers, actually withdrawing from the state. You and I had talked a little bit about this in our preparation for today's conversation. Can you talk to me about or share with us how it is what you think the impact might be of this sort of protection gap in insurance coverage on the overall stability of financial institutions in the broader economy?
So it is clear that insurance of various different kinds, housing insurance, but also automobile insurance and things like that, that's been a significant source of inflation over the last few years. And it's to do with a million different factors. It's nothing that we control from a regulatory or supervisory standpoint. In the longer term, companies are withdrawing from writing insurance in some coastal areas, and you got to think 10 years from now, how are you going to get housing insurance? And maybe the government will have to step in, but it's a significant issue.
Thank you, Chair Powell.
Thank you.
Senator Vance next. Yeah, Vance. Senator Vance of Ohio is recognized.
Thanks, Mr. Chair, and my gratitude to you and the ranking member for doing this hearing, and thank you, Chairman Powell, for being here. It's good to see you again. I think these hearings are always very important. Actually, give us an opportunity to sort of provide some oversight to what's going on at the Fed and better understand some of the things that you guys are doing that affect our constituents. I wanted to sort of focus on the Basel III regulations, Chairman Powell, and specifically the way that they have. There have been various proposals to sort of draw them down to focus on the regional banks. And to just go back to sort of one of the most significant crises, obviously, in our banking sector, of course, the collapse of SVB and First Republic. You and I have spoken in private and I believe in public, but one of the concerns that I have is when we talk about increasing capital requirements on the banks, if the banks were under higher capital requirements in the run-up to the crisis, there's maybe an argument that SVB, for example, would have bought more long-term treasuries, which would, of course, would have exposed their balance sheet to even more Treasury bond risk, and that, of course, would have maybe hastened the collapse of SVB. And I guess I want to start here with, when we talk about, some of the Basel regulations, what was the original intent? In other words, what was the original sort of proposal for which banks would fall under those regulations and which would escape them?
You mean this time around, or earlier on?
This time around.
So it's the 37 largest banks. It's down to, there's 4 categories of banks, including the G-SIBs, and this is down through the 4th category. The proposal that's out there now, I think, does extend to category 4 as well as 3, 2, and 1.
So what's the what's the minimum assets under management that you guys have proposed, the current Basel regulations?
100 billion.
100 billion.
Yeah.
And sort of that sort of gets to my concern here, because I know there's some discussion about whether you apply them at $700 billion of AUM or $100 billion of AUM. And maybe you could just sort of walk me through that decision process at the Fed, where you guys are and what would sort of justify drawing down from a $700 billion threshold to a $100 billion threshold.
So there's the G-SIBs, there's the 8 identified G-SIBs, and then there's one category too, I guess, and then there are the big regionals, and those tend to be, well-known big regional banks, and they're category 3, and one of them's a 2, I guess, but they have a different tailored level of regulation. And then category 4 had significant tailoring, and the question is, we have to ask the question, since SVB was a category 4, we've got to ask the question, what, if anything, needs to be changed in the way they were regulated, supervised from a capital and liquidity standpoint. So there was tailoring all the way down, and then below 100, of course, those are community banks, and that's a different regime as well. This makes sense. We want to have a diverse banking sector. That's a great benefit to our country, and very unusual for an advanced economy. So it's something we want to preserve.
Yeah, and I'm sure you know, Chairman Powell, but just to put this on the record, I mean, a lot of the commercial lending, a lot of the real estate lending, a lot of the consumer lending, about half of that lending, consumer lending, is provided by the regional banks. I believe that Huntington, in my home state of Columbus, is the #1 SBA lender in the entire country. So these, to your point, I think these do provide incredibly important benefits to our economy. And you hear a lot of people talk about the American economic miracle, and I do wonder if part of that is because we don't have the same type of financial system that has sort of dominated in Western Europe and other first world economies. I'm curious, in the process of amending the Basel requirements, have you guys made a decision about where to set the threshold yet, and when do you expect to set that threshold?
We haven't made any final decisions. We put out for proposals some months ago a proposal, and we've gotten a lot of comments, as I'm sure you're aware. We're chewing through those and digesting them, and we're just beginning now to sit down and talk about the changes that we'll appropriately make to the original proposal.
And when do you expect to sort of issue a final proposal?
I think it's going to take some time. I think it's more important to do it right than it is to do it fast. My guess is we'll get through this and be done over the course of this year. But it could be faster than that. It could be slower than that.
So I'm wondering, just being mindful of time, I have about 30 seconds left. Would you be willing to commit to say that in the process of amending, the Fed will remove the regional bank drawdown and limit Basel's application directly to the G-SIBs or $700 billion or above?
I can't get that specific at this point, but we're clearly looking at the whole tailoring issue.
I appreciate that. And again, I just repeat, Chairman Powell, given what actually happened with the banking sector with SVB and First Republic, I just encourage you guys not to apply a regulation that doesn't actually solve the underlying problem. And I fear that if you apply this to banks of $100 billion and above, you actually are doing just that. So with that in mind, I'll yield. Thanks, Mr. Chair.
Thanks, Senator Vance. Senator Tester of Montana is recognized.
Yeah, thank you, Chairman Brown, and thank you for being here, Chair Powell. We appreciate your work in a difficult situation, but I think you've done a really good job, and so thank you for that. Look, at success at the Fed on your mandate for strong employment and stable prices is critical for small businesses on Main Street, for farmers, for ranchers, for Montana families. You follow all the metrics. From your perspective, where is the economy at now, and where's it going?
The economy is growing at a healthy, sustainable, solid, strong pace, and that's one thing. Second thing I'd say is the labor market is very strong and quite tight still. 3.7% unemployment for the last 24 months. That's the longest period since 50 years. And the third thing is inflation. Inflation was too high. It's come down very sharply since the beginning of last